makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London with the conversations that matter. Here's what's coming up on today's program. European yields higher as investors wake up to America's strong manufacturing data. The odds of a June cut from the Federal Reserve dipping below 50%. And UK housing prices falling last month for the first time in the quarter, really, suggesting the market may be stagnating due to high mortgage rates and strained affordability. Plus, in commodities, oil rising as Tehran says Israel killed one of its top generals in a strike on Iran's embassy compound in Syria. A lot to digest there. Let's get a quick check on how these markets are faring, at least the equity markets across the continent. Green on the screen broadly, some outperformance right here in the UK with the FTSE 100. A lot of that really being driven by the yield story. Banking seems to be the sector that is outperforming. There's a lot to digest there because some of the other outperformers are going to be the commodity names. We just talked about the oil story, the gold story, all of that pushing some of the miners higher as well. So that is going to be crucial as well. In the meantime, we are getting some breaking inflation data. It has been a morning of inflation data across the continent of Europe. You've seen some really strong manufacturing numbers. Now you're getting them out of Germany as well. It looks like the Bavaria March CPI rising about 2.3% year over year. You've also got the Saxony March consumer prices 2.5% year over year, on a monthly basis higher by about 0.4%. Now remember, a lot of this, when you talk about the market reaction, has also been pricing in the data we got out of France, Spain, Italy, and of course the ISM numbers we got over in the U.S. as well in yesterday's session. So net, what does that mean for the euro? Well, right now you are looking at some euro weakness on the table. It marginally got into positive territory against the dollar, now paring back some of those gains, 107.35 on that currency pair. The theme here seems to be Europe is kind of chugging along, for lack of a better term. I'm curious how a true expert interprets this. Let's bring in our guest this morning, Aberdeen senior research economist Sri Kochu Govindan. I hope I said that name right. I apologize if I didn't. These numbers are largely manufacturing across Europe seems to be stronger than expected. Germany seems to be the continuous weak spot. How much of a positive or negative is that? What's your interpretation?
I think there are some positive signs in there, as you say, but overall, what we've seen so far in the euro area is that it's very narrowly missed a technical recession. Now, going forward, I think there are likely to be some sort of tailwinds in the second, which will start to materialise in the second half of the year. More meaningfully, where we start to see the impact of, the rate hikes have, largely that's behind us. And then, as we've had indicated so far, particularly in the ECB Watchers Survey, Watchers Conference recently, that there's likely to be rate cuts beginning in June. I know that's a big debate over the weekend.
Yeah.
But as that feeds through, we're likely to see some stabilisation in the euro area economy. Manufacturing data still got a 4 handle there with the PMIs, still in the 40s. So it's not ideal, but we do expect to see that sort of stabilising and recovering going into the second half of the year.
You mentioned a little bit about the Fed pricing changes over the weekend. It has been volatile when Europe has been enjoying their long weekend.
Yes.
We're now seeing those cuts getting pushed back further and further, which begs the question, do you see that divergence between the U.S. and Europe accentuated? And is that even a problem?
I think that obviously there are risks. I mean, we still have penciled in a June as a start of the rate cut for a number of central banks, including the Fed, euro area as well. But obviously what we've seen over the weekend has really been the data. All of these central banks are data dependent. It will be very heavily reliant on what happens to inflation, and in particular core inflation. So core inflation we are expected to be relatively sticky and stable, but the key areas there would be the services sector. So what does this mean? I guess there are risks that we could see a delay in the US. But I think for the euro area, they would really need to be focused on their economy, looking at how, inflation trends are decelerating. They are on the correct path at the moment. And we do expect inflation to sort of dip below 2% later on in the year. So there are some good signs there. Even for the Fed, there are some good signs from the core PCE. But obviously, it's the breakdown where we're starting to see, the core inflation, if you annualize that, smooth it over 3 months, it's still not quite going in the right direction.
Yeah.
So possibly some delays, not derailed, but delays. Obviously, there are some upside risks that we're seeing coming through in the headlines.
There absolutely are. Hold that thought, because we are getting Germany numbers as well. More regions of Germany. Germany's North Rhine-Westphalia, I hope I'm saying that right as well. Their March CPI numbers rising about 2.3% on a year-over-year basis. We're still waiting for the monthly numbers and the breakdown there. But net-net, what you are seeing is that deceleration theme that you were just talking about. You're seeing it on both sides of the Atlantic. As we get that breakdown, we'll bring it right here. I want to come back to the manufacturing story, though, because we're talking more about that core inflation story kind of stagnating, driven by the services data, as you point out. What do you make of this manufacturing data that's come about? And even just in the last hour or so, we're seeing strength in French, Spanish, Italian manufacturing data, not necessarily Germany, but that's its own kind of story. In line, just less than 24 hours after we got that ISM data out of the States. Is manufacturing relevant again for the U.S.?
I think within context, it's still a smaller part of the economy, but it is very important in terms of a signal of the overall trade picture. And we've had a lot of focus on what's happening with new orders, production picking up in the US, and this is important from global spillovers as well. So yes, these are good signs that we've avoided a recession, that there is some stabilization. So yes, even though it's just less than 20% in some of the economy, in some economies, it's still relevant in terms of the direction of travel and the fact that we have narrowly missed a recession in a number of countries, including Japan as well. We've had that revision in data which shows that whereas it was a technical recession, moving into a marginally positive. So even though it's sluggish growth, it's still avoiding recession and therefore a positive story.
If it's a positive story, let's talk about the positive or not so positive story in Europe as well. Bringing it back to that theme of divergence here. In Europe, when we're talking about this weakness in Germany in particular, what does contagion look like to the rest of the continent, especially when we're seeing French, the services numbers, kind of staying fairly strong relative to its German peers. You're seeing outperformance in Spain and Italy. Guy Johnson and I were just talking about this on the last show as well. Is that an impact of kind of fiscal stimulus that you're seeing Italy, for example, pumping money into their economy in a similar way that the United States is as well? The UK kind of doing its own thing with its housing story, so I don't want to loop that into the ECB. We do see a lot of these European continents traditionally perform together, except right now the narrative seems to be quite different per European country. The Germany story is the outlier here. When does that seep into the rest?
I think there are some idiosyncratic factors there for Germany, and these are some structural headwinds as well, unfortunately. The nature of the economy has changed. The dynamics have changed in the sense of, cheap energy, which had been a benefit for many years. That's now behind them. They were very, very reliant, obviously, on Russian energy. So there are some structural headwinds there, which they are working around. It is difficult for the rest of Europe to remain immune. You are correct there. But this is part of the decision-making process for the ECB. It's not just an inflation story there. They will be monitoring this activity data in Germany. And again, as we start to see the cuts coming through in the second half of this year, that will be a benefit for all of the economies. And furthermore, as you mentioned, there has been that fiscal tailwind so far. Unfortunately, that will start to fade for a number of countries across Europe as well as in the US. That was a tailwind that is starting to fade as well. So it's a bit of a net. It's still sort of sluggish growth that we're expecting across.
So what does the ECB pay attention to when it comes to Germany? We're talking about this contagion or lack thereof, as you point out. You kind of laid out the scenarios there. Should the ECB be more sensitive to the German story because of that read-through, given that Germany is still the largest economy in Europe? Or does it kind of ignore Germany for a little bit and pay attention to the strength everywhere else? Either way, it feels like a lose-lose for the ECB.
It is difficult. Obviously, they would say we consider all of the economies within our assessment, and they wouldn't sort of single out any particular country when they're discussing their views. But at the moment, they are very much focused on the services side of the story. So I know we had manufacturing data out earlier, but it is still that services inflation and what's happening with wage growth, real incomes, and these factors are starting to improve. And again, as we move into the second half of the year, we should see real incomes improving and some increase in spending, which we haven't really seen in the last few months, and that should start to feed through. And I think those are the factors they'll be looking at. But yes, Germany is a key economy that does have spillovers, so it's difficult to ignore what's happening there.
Stuck between a rock and a hard place, it seems like. So much to digest. We look forward to having you back on. Thank you so much for joining us this morning. Aberdeen senior research economist Sri Kochu-Govindan joining us this morning. In the meantime, we were talking about the outperformance in some of the European economies. Let's talk about outperformance in the UK stock market at the moment. The FTSE 100 headed for a record high close, up by 0.8%. Look, a lot of this is driven by two main sectors. The banking story, you're already seeing that massive move in gilts pushing the banking sector higher. You're also seeing a move in commodities this morning, also pushing some of the miners and some of the big oil higher as well. Shell, BP, alongside the likes of HSBC, Standard Chartered, Barclays, Lloyds. Those are your outperformers this morning, not to mention ASML is higher as well. That listing higher by, I think, 2.4% the last time I checked. All of that putting, again, the UK index to a record high. How much of it is it a catch-up trade? How much of it is driven by the fundamentals? We're going to stick with that story and monitor it for you. In the meantime, coming up on the program, we go from the stock market to the oil market, nearing a 5-month high. Oil trading higher. A lot of that on that Middle East risk and tightened supply. We're going to dive into that story next. This is Bloomberg. The conversations that matter and the insights you need. Welcome back to the Pulse. I'm Kriti Gupta in London. Iran and Syria say an Israeli airstrike on Tehran's embassy in Damascus has killed several people, including 2 military generals. Iran's foreign minister says Israel should be held accountable for the repercussions of the attack as tensions grow between the longtime adversaries. Let's get a little bit more context here. Joining us now for more is Bloomberg's Dana Kreisch, joining us from Dubai, I believe. Dana, a pleasure to have you on the program. Walk us through the story. What do we know so far?
Yes, well, we know a suspected Israeli airstrike hit a compound linked to Iran's embassy in Damascus, killing at least 7 Iranians, including a high-ranking commander and his deputy. Images out of Syria show the building completely demolished as a result of this airstrike. Now, Iran did vow revenge, but Israel doesn't really comment on such attacks and has never done that. But it has said before and repeatedly that it would stop or obstruct weapons transfers via Syria or attack any Iran-linked assets to whatever it thinks is a threat to its existence.
Speaking of that threat to its existence, this has been a narrative that's been going on for a while here. How much of what we've heard in the last 24, 48 hours is actually an escalation?
This attack is quite an escalation, and Israel with it has upped the ante of its airstrikes in Syria. So since the October 7 attack against Israel, the northern front by Hamas, we have seen repeated attacks by Israel on Syria, attacking Iran-linked assets, including those linked to Hezbollah. And with this one, it's a more direct attack. This is a compound linked to Iran's embassy. It's more direct. It's more of Iran's official representation in Syria. And so it remains to be seen how Iran would retaliate against that. And it has repeatedly now, since last night, vowed retaliation. The Iranian foreign minister also said that he sent a message to the U.S. about this attack and kind of holding the U.S. responsible for it as well.
Well, speaking of that retaliation story, what does that even look like?
So earlier this year, we saw Iran attack Erbil, saying that there was kind of a spy headquarters linked to the Mossad, and it struck Baghdad as well and Iraq. Now, it can do that, but I think that Iran would probably retaliate and attack in a way that it won't hit a very harsh nerve here. We can see this probably via the Houthis upping the ante in the Red Sea, or Hezbollah maybe escalating attacks on Israel's northern border. But it probably will be calibrated, as Iran has repeatedly said it does not want or intends to be involved in a wider Middle East war.
All right, Bloomberg's Dana Kreisch monitoring those developments for us out of the Middle East. We thank you so much. Let's talk a little bit about how the geopolitics translates to the markets there. Oil holding near a 5-month high with heightened geopolitical risks and those supply constraints both creating a little bit of a tailwind to prices. I want to get a little bit more context here. Bloomberg's Anthony DiPaolo joins us this morning. Anthony, we've seen the oil market, and I would argue broader risk assets, kind of shrug off some of the geopolitics, especially some of the tensions coming out of the Middle East. How much of today's move higher is driven by the news that Dana was just walking us through?
Yeah, we did see a little bit additional jump in the oil price due to that, so it did give it a little bit of juice. We do have some risk premium in the price because of everything that's going on in the region, but oil perhaps hasn't reacted as strongly as one might think to a lot of the attacks on shipping in the region and generally the state of war in the region. As far as those shipping attacks go, we haven't really seen oil supplies affected per se. It's taking longer. Insurance, shipping rates are up a little bit, so that's coming through in a little bit of the general cost to the market. But we haven't seen those supplies impacted yet, and so that's the real issue why oil hasn't been reacting as strongly. But we did see some strength in oil in the first quarter, and it's keeping those gains now a little bit stronger after this attack in the Middle East now. But we are continuing to see that, and that's partly because of those OPEC plus cuts that are affecting exactly that supply in terms of the market. So we're tightening a little bit, and OPEC is expected to, at a meeting this week of a technical committee, not to make any recommendations for change. So we're probably going to see that through the rest of this quarter, Kriti.
It's interesting that you mentioned OPEC Plus. We will have a lot of headlines coming out of Mexico as well in terms of their supply. You have headlines coming out of the United States hitting those record oil exports, kind of trying to seep in to those other markets around the world. Is OPEC Plus concerned about that at any point? Is there something that's going to kind of seep in when we talk about that excess supply?
Well, one of the challenges that OPEC Plus is dealing with, and one of the reasons why they are reducing production, is because of all that non-OPEC supply that's coming on. So the U.S. is bringing on supply this year. There are new supplies coming on from Brazil, from Guyana. And so those additional barrels in the market are going to take up a lot of the extra demand increase that we expect to see this year. So that's that challenge for OPEC. Where do they find the space for their oil to come back into the market? And so that's what they're dealing with. That's why they're taking those barrels off the market now, so that they stop inventories from building. And they want to see that market tighten before they begin putting those barrels back. So right now, a lot of the analysts looking at the market are expecting that the market will be tightened by the end of the year. And so that's kind of the framework, the time frame when OPEC could come back into the market with those additional barrels.
All right, Bloomberg's Anthony DiPaolo joining us from Dubai, walking us through some of the dynamics in the oil market at the moment. Coming up, we go from the commodity story to the broader macro story right here in the UK. We'll be discussing UK house prices nationwide reporting their first dip in the data for the first time this quarter. More on that next. This is Bloomberg. South Africa's main opposition leader says he would resist forming a coalition with the ruling ANC, speaking exclusively with Bloomberg.
We have already got a pre-prepared agreement about how we're going to work together, how we're going to stabilize a coalition, and how we're going to make sure it governs effectively.
Why not just have one single party ruling the country? I mean, is it because of the past 30 years of the ANC? What is it that you're so opposed to? I
think that if you look in South Africa, people are very brand loyal to organizations and brands. It would be, I think, foolhardy a year before an election to form a totally new party and expect it to get the name recognition and the traction.
I mean, we're seeing a lot of new parties.
We are seeing a lot of new parties, and we're seeing the fact that they're not making the breakthroughs that people would expect them to, precisely because they're unknown quantities. we're hoping that the multi-party charter, the whole is going to end up being greater than the sum of the parts. The IFP can go on the hunt for votes in rural KwaZulu-Natal. The Freedom Front can bring votes in from rural parts of the northwest and those communities. The ACDP can bring in the religious voters, and to bring all of those to the table to form a big pile of chips that can be used to be able to form a government.
What about the DA and the ANC?
No, we don't want to be in government with the ANC, and that's precisely...
So that is out of the question?
No, it's precisely why we formed the multi-party charter. My job is to get the ANC out of government. I don't think we're going to solve the country's problems by having the same people who are responsible for the economic crisis, the social crisis, and the infrastructure crisis sitting around the table. We've got to change them, and that's why the multi-party charter has said we will not do deals with the ANC or the EFF.
What if we see a scenario where the ANC still is somewhat in the majority? Is the DA going to rule out working
We
with
will
the
go
PMO?
back to the multi-party charter, and we will decide on what the best option for it. It may be a minority. Maybe we could form a minority government as a multi-party charter. I just think there's too many unknowns at this stage to say my focus is on getting the ANC way below 50% and getting a new set of people around the table so we can get our country off this low growth, high debt, high unemployment trajectory.
The latest German data showing inflation largely cooling, whereas the rest of Europe actually outperforming. That could support traders betting on the ECB cutting interest rates as soon as June, or maybe not. European yields also higher as investors wake up to America's strong manufacturing data. The odds of a June cut from the Fed dipping below 50%. Plus oil rising as well as Tehran says Israel killed one of its top generals in a strike on Iran's embassy compound in Syria. Red Crew trading an 88 handle. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. We talked a little bit about the European inflation story. There's also an inflation story right here in the UK, starting with housing. UK house prices falling, however, in March for the first time in 3 months. This data coming from Nationwide Building Society suggesting the market may be stagnating due to high mortgage rates. We're expected to get that data in just a few seconds amid some of that strained affordability story. Let's get more on the story with Bloomberg's European economist Neeraj Shah. Neeraj, talk to us about the data that we got first to begin with. This dip in housing prices feels more like a stagnation story than a proper deceleration.
So it highlights how the recovery is going to be bumpy ahead, really. So you had actually quite robust growth at the start of the year, the first 2 months of the year, and then you've had this slight dip. But overall, we've turned the corner, and ahead it's going to be more bumpy, and this really highlights that.
Well, speaking of bumpy, we're actually just getting that mortgage approval data as we speak. That February number is coming in about 60,383, a very specific number, but significantly higher than the about 56.5 that was expected. Double-folded question here. One, does that data signify anything in terms of the fact that we're coupling it with that dip in the nationwide prices? What are you waiting for the data to be more promising?
Well, that actually already is quite promising, 60,000. That's quite a significant jump. And it's only about 6,000 below the long-term average. So that suggests that people are going back into the market, applying for mortgages, and there's always a lag. So this is going to be 3 months ahead.
Yeah.
You're going to see a slight more pickup. So that's actually quite encouraging. But again, a lot depends on the Bank of England and when they cut rates. We've already saw at the start of the year, rates was dipping, mortgage rates, and they've crept up a little bit because expectations have tempered. But essentially, we're expecting rate cuts from June and rates to end at 4% this year and 3% next year. That would get the housing market going.
So resiliency seems to be a little bit of the theme here, starting to kind of come back in. It hasn't crashed yet. You've made the argument in the past that there was an expectation that maybe it should have a year ago. Why didn't that happen?
So it's a great question. So really, you saw this incredible rise in interest rates. But the big thing was people kept their jobs. Unemployment still remained near record lows. And also a lot of people were on fixed mortgages, so they had time to adjust. So you didn't have the forced sales that would flood the market. And that was a big reason why prices didn't crash. But you did have a correction. So the nationwide house price is still 4.5% below their peak in 2022. And in real terms, when you take into account of inflation, they're down about 15%. So there's been a correction rather than a crash.
I love that. Correction rather than a crash. Is that music to the Bank of England's ears, or is that they're still more concerned? Is there still more of a kind of sensitivity around some of the data?
I think that is music to the Bank of England's ear, and it's something that reassures a lot of people. We want a kind of Goldilocks recovery, and there's still some concerns over wage growth and whether inflation won't actually fall or come back up a little later on. So, but overall, it's encouraging.
A final question on just kind of where the extra supply may or may not come from. There's some big promises on the fiscal side about, at least in terms of the Labour government, what the extra supply in the market may actually look like. Does that make a difference to this data at all?
So that's more long term. But one thing that does make a difference is we just had last week Yorkshire Building Society offering mortgages with a 1% deposit. So that might help some of those first-time buyers really struggling to get a deposit together. You've just had other data showing rents have gone up to a record above £2,000 for the first time in London.
Yeah.
So they're scrambling to get a deposit together. So this just might help them.
The affordability story at its core, and one that really is a global one. We thank you so much for bringing us a little bit more insight. Bloomberg's European economist Neeraj Shah talking to us about the UK housing story and where it may or may not be going wrong. And sticking with some of the data that we got it from the UK. We also got some US data in the last 24, 48 hours where you've seen some really big sensitivity, strong factory data in particular, prompting traders to price in less easing from the Federal Reserve this year, setting the odds of a first move in June below 50%. That all squared with some caution from Jay Powell on Friday.
The report that came out this morning is pretty much in line with our expectations. We're making progress. This is good, but we need to see more. The decision to begin to reduce rates is a very, very important one. The economy is strong. We see very strong growth. We had growth for last year over 3%. We don't need to be in a hurry to cut. It means we can wait and become more confident. I don't think rates will go back down to the very, very low levels they were at before the pandemic. This economy doesn't feel like it's suffering.
Let's bring in Bloomberg's Ven Rom from our Markets Live team. Ven, this sensitivity to the ISM data, we usually don't see a sustained move like we do or like we did in the last 24 hours. An 10 to 14 basis point move based on where you look at the curve. It traditionally tends to be a knee-jerk reaction that then kind of comes back. Why the sensitivity to American manufacturing now?
Morning, Kriti. The sensitivity owes in large part not so much to the ISM headline number, but the prices paid number. If you look at that gauge, prices are back up to the highest since July 2022. That is, of course, when the Fed had just started raising rates. So basically, if prices are going to go back to those levels, and the market's worst fears are being kindled, which is that, look, if the Fed's cumulative policy tightening of 500 basis points hasn't made much of a dent on price pressures, then what is to stop a reacceleration of inflation? That speaks to the market's worst fears, and which is why you got the kind of vehement reaction that you got in treasuries last night.
We're talking about the read-through, though, for the rest of the world here. If we look at some of the manufacturing strength that you're seeing in the United States, well, it was matched in just the last hour to 2 hours in Italy, in Spain, in France as well. All those manufacturing numbers coming in hot this morning. What is the trade there? Is this an early sign that people need to start hedging inflation again?
Yeah, possibly. I mean, we should prepare for, I think, forget 2% inflation targets. I think we are more like in the cusp of 3% inflation. That's going to bob around those levels for some time now. I don't think we are expecting a reacceleration of inflation back to those numbers that we saw, horrendous numbers that we saw in 2021 and 2022. But 3% feels like the new 2%, and the market should prepare for it.
How does the market prepare for it, though? There is one part of the market that is piling into gold. On the surface, it looks like an inflation hedge. It may or may not be, depending on where you actually see that demand coming from. What are the other ways to actually position for it?
Well, the best way to position for it is in terms of real rates. Real rates are going to go back higher. I mean, they're a lot stickier already. In this quarter, we have seen real yields back higher, and that will go higher, even higher from current levels. The dollar is going to be a lot stronger. So those are the two cleanest ways to position for this new inflation regime that we've got.
A really interesting dynamic. I'll save the last one for you. This is kind of the wild card that I got to say I can't really fold into the global inflationary story either. Let's talk about the lira, because record highs for gold, but also some very interesting levels for the lira as well. A lot of that driven by some municipal election results. This is a market that a lot of people have already pulled out of. Not a ton of exposure here, but one that people I think like to watch is kind of almost from a spectator perspective. Your take on the Turkish lira?
Well, I think that the lira has fallen a lot over the past 5 years. It's kind of lost more than half its value, and this year alone it's fallen more than 8%. Look, the bulk of the currency adjustment to the macroeconomic fundamentals has already taken place. And I think the investors are going to wait and watch from here to see how inflation evolves. We are expecting the headline inflation numbers to come out again tomorrow. And if it's going to bob around current levels, I think the markets are going to be okay with it. If you look at the 1 month inter-deposit rate, which is a function of market expectations on where the Turkish 1 week benchmark rate is headed, I think that the markets are not thinking they need another massive hike like the 500 basis points that we got from the Turkish Central Bank last time. So I think that, the worst case fears are being laid to rest here. But, politics is something that we can't factor in. I mean, so that is going to be a big that's going to be a big canary in the coal mine, and investors have to watch for it, watch for any risks from there. But I think that the bulk of the currency adjustment has already taken place.
An interesting one to watch for sure. Bloomberg's Ben Rom, we thank you so much for your analysis this morning. We make a strong pivot here away from the markets to a very exciting guest we have coming up. We speak with the latest innovator featured in Bloomberg's Industry Shakers, Fande Doumbouya, founder of Labrum, joining us as we look at the future of British luxury design. Stick with us. This is Bloomberg. The conversations that matter and the insights you need. Welcome back to The Pulse. I'm Kriti Gupta in London. Industry Shakers is a Bloomberg special series profiling Black and diverse entrepreneurs and innovators across a range of sectors. My next guest is creative director of fashion brand Labrum, which combines West African heritage and values with classic British tailoring. His collections have featured a collaboration with Adidas and Guinness, and last year saw him presented with the Queen Elizabeth II Award for British Design. I'm pleased to say Fande Doumbouya joins me right here on set. Welcome to Bloomberg. It's a pleasure to have you on the program.
Thank you.
Look, we're a financial network first, so we got to start off with the business aspect of this. Yeah. West African design meets British tailoring. Talk to us a little bit about the audience, the market that you're trying to target.
Well, thanks for having me in the first place. My audience is quite mixed. Like I said, we're telling West African stories together with British tailoring. So it's a global audience. It's the people that understands the stories and people that know why people move and people migrate from place to place and how that touches them. Their world. That's what we're trying to do. It's the messaging more about than the clothing. It's all about communities, about how we bring those people to life within those designs. That's what we're about. So if you ask me in terms of what's the reach, it's like global. So you could be anyone that could wear my clothes. So it could be Asia, Europe, Africa, America, everywhere, to be honest.
Who are you competing with? When you look at your peer group in the luxury space, who do you feel like is the market share that you want to get?
For me, in terms of market share, I'm kind of taking it from different people. For example, Oswald Boateng does really amazing suits and then mixing colors. So some of those are some of my market. You have my peers, people like Bianca Saunders. We tell stories a lot, and she tells stories about a Caribbean culture, and I tell stories about African and British tailoring. So those are the people that I see that kind of like fits in within my market, together with the likes of Nicholas Daly and people like Aliwalia as well. So, and also, when we talk about bigger brands and we talk about the likes of Burberry, and it's what they do, how they interpret prints in their storytelling.
I love that we're talking about kind of prints and the appetite for luxury right now, because you'll know better than anyone that we're coming in an environment where luxury, they're able to keep their kind of core wealthier audience and wealthier consumer demographic. But when it comes to that kind of mass market consumption, we're in an inflationary environment, we're talking about a recession, et cetera, there isn't as much appetite for luxury, even in the States, from kind of that mass market consumer. What changes that? How do you appeal to someone who says, I can't afford the bigger brands?
Yeah, again, like I said, the thing about Labrum, the thing about our garments and the design, it's more about the storytelling. I think we sell the story, people buy into the story, become a fan, and then we take them through the journey of how the garment is created, from design in London, development fabric in France and the UK. And I think once the consumer kind of understand that journey, and they tend to want to connect and buy the product, because the people that actually just look for cheaper product probably doesn't understand the story behind it. And if you understand the story and also the longevity of the garment, sometimes it kind of sway your purchasing power. So I think those are the people we appeal to, people that love stories, buy into the stories, connect with brands, and the things that make them feel like they're part of the journey. I think that's what we were trying to connect with. Because sometimes if you look at the mass market, it's very difficult to compete, because the likes of Primark doing garment for like £5.
Yeah.
We don't compete in that, because we know that's completely out of what we believe in. So what we're saying is pay people for what it's worth. So what we're developing is we work with artisans in Africa and all over the world, because we believe in what they try to create. And that's why the brand tells the stories, and that's why the price point is what it is, and the luxury where we sit in.
You use that word artisanal,
yeah,
which to me thinks of quality fabrics, crafting, and classics and classic pieces. And when I think of classic pieces, I think of Adidas, for example, or Adidas, as I'm told is pronounced in this part of the world. You have a collaboration coming up with Adidas. Talk to us a little bit more about how you're collaborating with other more established brands.
Yeah, it's collaboration is a beautiful thing, because you're tapping into other brands, like sort of network, their consumers. With Adidas, they believe in the story that I tell. They believe in my journey, so they've been supporting me for several years now. I think to them, collaboration is always like, how can they amplify an up-and-coming brand story? I think that's where they come in on this. I've worked with like several collaborations with them recently. I did a samba for my show, which was again inspired by the Normally, and which is a story back home where I'm from. And then also we're working with them designing the Sierra Leone Olympic kit, which hasn't been unveiled yet anywhere. So it's just a conversation we're having about that. It's been worked on, it's been designed. Hopefully we'll showcase that at the end of the month or maybe May. So again, they don't just collaborate, they bring their resources, they support you. I think that's the interesting thing about collaboration, because you tap into resources that you probably wouldn't have.
So you talked about the Adidas collaboration. Any others on your radar? What's on your wish list?
I have interesting stuff coming up, which unfortunately I can't talk about. Hopefully will be out.
To give us the exclusive when it comes out.
Yes, we'll try and make sure we do that. But yeah, my wish list, is to work with Adidas in an aspect that I wish I could say much about that, but yeah.
We'll come back. Talk to us a little bit about then of your expansion plans. You're already in Selfridges. You're already in Harrods. You mentioned the United States as a market that perhaps you want to expand to or have a bigger reach at. When you're talking about department stores and that mass consumption kind of story, you're already partnering with Adidas. To me, as an American, it comes Macy's, Bloomingdale's, Dillard's, Nordstrom. Any of those on your radar?
Yeah, Nordstrom specifically is on my radar, to be honest. And also, we did stock in H. Lorenzo in LA. And for us, I think it's not about huge. It's more about, can this store represent us? Can they tell the story that we tell? I think that's why we work with Selfridges and Browns in London, because they kind of embrace the story, showcase what we do, and then that's what we look for partnership in terms of like the stores that we go into. Yes, Nordstrom, we've been talking to them for a while now, but I think for me, selecting those stores is, can they represent us? Can they represent the story behind the garment? Yeah. And I think that's why we're going to select like a handful of some of the stores that we can go into, because we don't produce a lot. Yeah. So we produce like what consumer can consume, and we also do a lot of bespoke, because we develop all our fabrics ourselves. Is to give the consumer these options of like coming to one of our store. Hopefully we'll be opening a store in a couple of weeks, for consumer to come in and be able to kind of select those fabrics, and we can make something for them. I think that's that niche the brand has. All
right, very quickly, I'm going to put you on the spot. Any pushback that you're getting in terms of department stores, in terms of collaborations, anything, any hurdles that you're finding, very quickly?
For now, I think the hurdles was like some of the stores, they probably think very, very huge and numbers. And then for us, it's more like we want it to be niche. We want it to be more about the storytelling, and don't oversaturate the market. And I think that's some of the pushback, because some of the stores are so huge, they look at big volumes. And I think because of what we do and then the way we portray the product is probably doesn't work for them. But the stores that actually understands it, they always carry us. So,
Fade, a pleasure to have you on the program. I feel like I've learned so much in the last 10 minutes or so. We thank you so much for joining the program. Fade Doumbouya there, founder of Labron, joining us for a little bit more about his business and his story as well. Coming up on the program, Tesla's trading lower pre-market as analysts lower projections for the EV maker's latest deliveries report. Details ahead. This is Bloomberg. We are expected to get Tesla's deliveries report today. Wall Street analysts lowering the projections over and over again, though. What gives? Let's bring in a true expert. Craig Trudell joins me right here on set. Craig, walk us through some of these numbers and why people are more and more pessimistic.
Yeah, we saw consensus really drop like a rock as the quarter was coming to a close. A lot of softness we're seeing in China toward the end of the quarter. Our colleagues in China reported that the Shanghai plant will move down to a sort of lower schedule of production. We're also seeing some weakness in the U.S. in terms of basically just, these are tired models after all. The Model 3 and Model Y have been out quite a while. This is a company that desperately needs to bring new product to market. The Cybertruck, of course, only just started sales late last year, but that's a low volume product. And looking like it's going to remain that for some time because of the challenges of manufacturing it. So this is a company that is just expected to have trouble until they bring that cheaper model to market, hopefully late next year.
And we've already seen the stock at least trade pre-market a little bit lower. Craig Trudell, our Global Autos editor, we thank you so much. This is Bloomberg.